Welcome back to the Frugal Millionaires podcast, where we explore all things personal finance, self-development, and business. Before we get started, please hit that subscribe button and also don't forget to turn on those post notifications so that you never miss any of our future content. Follow us on Instagram, Facebook, and TikTok at Frugal Millionaires. So let's go ahead and get started with today's episode.
My name is Brieon Mitchell, a corporate professional, investor, content creator, expat living abroad, and a frugal millionaire.
We're going to be exploring 5 key real estate strategies to reduce your liability, even all the way to zero. You may be able to potentially reduce your tax liability to zero if implementing these 5 strategies, either some or all, effectively. So let's get started. Number 1, depreciation. What is it? Depreciation is a tax deduction that allows real estate investors to recover the cost of an income-producing property over its useful life, as determined by the IRS. It acknowledges that assets do wear out, they become obsolete, or even get used up over time. So for residential properties, the IRS typically sets its useful life at 27.5 years. And for commercial properties, it's 39 years. This means the cost of the property, excluding the land, can be deducted over these periods. Each year, a portion of the property's value is written off as an expense, reducing taxable income. What's the benefits of this deduction? It's simply a non-cash deduction, meaning you don't have to spend money annually to get this deduction. It helps in offsetting the income generated from the property, thus reducing the overall tax burden. Very, very important to capitalize on depreciation. Number 2, mortgage interest and property tax. These are costs associated with borrowing money to purchase a property and the taxes paid to local governments. And this can be your local governments. This can also be your county, or in some states, parish governments. And how does it work? Mortgage interest and property taxes paid on any investment property are tax deductible expenses. For mortgage interest, this applies to the interest paid on loans used to buy, build, or even improve the property. Property tax deductions can vary based on local tax laws. The benefits is that these deductions, again, lower your taxable income. Since interest rates make up a significant portion of your mortgage payments in the early years, this can be a huge deduction. So make sure you don't miss it. Number 3, expenses and capital improvements. What are they? Expenses are costs incurred in the operation and maintenance of a property, while capital improvements are significant upgrades or additions that can increase the property's value. And how do they work? Operating expenses such as repairs, utilities, insurance, property management, etc. All of these are fully deductible in the year that they are incurred. Capital improvements, however, are not immediately fully deductible. Instead, they are depreciated over the useful life, similar to the property itself. The benefits are both of these deductions help offset the rental income, thus reducing your taxable income. They also improve the property, which potentially, and in most cases, increases value and rental income potential. Number 4, cost segregation. What is cost segregation? Cost segregation is one of those advanced tax strategies that involves identifying personal property assets within the real estate investment that can be depreciated over a shorter time frame. And in most cases, if done properly, a cost segregation can help you to depreciate or either write off these assets in year one. But how does it work? It involves a detailed analysis of the property to segregate costs associated with items that can be depreciated over time. This is things like appliances, carpeting, landscaping, and other similar items. So look into a cost segregation study. It can truly benefit you in a huge way. It accelerates the depreciation deductions, providing a significant tax savings in the early years of your property ownership. This can improve your cash flow and increase the present value of those tax deductions. Last but certainly not least, 1031 exchange. This is named after Section 1031 of the IRS Code. It's a strategy that allows investors to defer paying capital gains taxes on an investment property when it is sold, as long as another like or in-kind property is purchased with the profit gained from the sale. But how does this work? The investor has a set period of time to identify replacement property and complete the purchase. It must be of equal or greater value, and the exchange must be completed within that specific time frame. The benefit is that you defer your capital gains taxes, allowing you as an investor to use this and the full proceeds from a sale to invest in another property. This can significantly enhance your ability as an investor to grow your real estate portfolio and compound wealth over time. The key thing here is each of these strategies requires careful planning and adherence to specific IRS rules. So each of these should be carefully crafted, and I advise you to work with a reputable tax professional to navigate each one of these strategies effectively. So there you have it, Frugal Millionaires family. A look at the 5 real estate strategies to reduce your tax liability, and in some cases, even reduce your tax liability all the way to zero. Thank you for staying with me until the end of this episode. If you have any personal experiences or insights, feel free to share those with us down below in the comment section. Please give this video a thumbs up, to like, also subscribe, and turn on post notifications to stay updated about our latest content. Also, don't forget to follow us on Instagram, Facebook, and TikTok at Frugal Millionaires so we can connect with you more. Thanks for watching, and see you in the next one.